clear on the why before you even think about the how, and setting specific, measurable goals, I assume.
Exactly. Identify specific investment goals. Like, I want to aim for $1 million for retirement, or maybe $50,000 for a child's college fund. Use investments for these large, long-term goals.
And for shorter-term stuff.
Yeah. For smaller, shorter-term goals, like needing, say, $10,000 for a car in 2 years, a high-yield savings account is generally a better, safer option. The stock market is too volatile for short timelines like that.
Got it.
Next, you need to calculate your time horizon. This is simply how long you plan to keep that money invested. So for a child's college education, if they're 4 years old now, you have about 14 years until they start college.
Okay, so for a relatively shorter horizon, like 14 years, you choose lower risk investments, is that right?
Generally, yes. Compared to someone younger, if you're, say, 25 and investing for retirement at 65, you have a 40-year time horizon. That longer runway gives you more leeway to take on potentially riskier investments, like more stocks, because you have ample time to recover from any market downturns along the way.
Makes sense. Time smooths out the bumps.
It can help. And while returns are never guaranteed, of course, understanding average historical returns can help you estimate roughly how long it might take to reach your goals with a certain investment mix.
Okay, so you know your goal, you know your timeline. What's next?
Set an investment budget. This means really understanding your current financial situation. Create a household budget, income versus expenses, see what's left over.
And once you have that clear picture, you can figure out how much you can realistically allocate to savings and investments each month or year.
Exactly. And your budget also helps determine the kind of rate of return you might need to reach your goal. For example, if you consistently invest $500 a month for 40 years, that's $240,000 you've put in. To reach a significant goal like $1 million, you'd need an average rate of return of at least 6% over that whole period.
So the numbers start to become real.
They do. And a crucial tip for newcomers: practice before you play. Seriously. Use a stock market simulator.
With fake money.
With fake money. Hone your strategy, learn how the investment platform works, get comfortable. Many online brokers offer this feature now. It's a great way to learn without risking real cash.
Okay, that's really practical. So once you're ready to actually invest real money, how do you start building a diversified portfolio, especially if you're new to this whole thing?
Right. First, you'll need to open an investment account with a brokerage firm. You typically need a broker to buy stocks, bonds, funds, etc. It's smart to compare different online brokers, look closely at their trading fees, any account maintenance fees, the tools they offer.
Do you research there too?
Absolutely. Then a great way to ease in is to maybe start with companies you're already familiar with. If you love Apple products, maybe your first